And welcome to the Behind the Dollar Signs podcast with your host, Mark Taylan. Mark, great to be with you again. It's good to see you. And I love today's topic because a lot of people think, man, all I got to do is I just need to bring in that nice, sweet, high income and it's going to be a beautiful thing. And it will be a beautiful thing. But there's some things to remember because that's not quite all of the story. And that's what you're talking about today, Mark. Good to see you.
Hi, Bill. It's great to see you as well. Yeah, it's a great topic. And, I work with a lot of, high net worth clients and they come in and they've done a great job in accumulating assets, in their working years. Now they're starting to focus on, hey, do we have enough money to retire? What does it look like? And what they often don't realize is when you think about all the money they've accumulated, and then they've got pensions and they've got Social Security and they've got all these things that are coming up, they're going to be in a really high tax bracket in retirement. And most people have been told, you work in your earning years, you make a lot of money, but when you retire, you're going to be in a lower tax bracket. And I got to tell you, that's really not the case for many people that I meet with. So it's kind of eye-opening to see like what the impact of being really successful at accumulating a lot of assets.
Yeah, taxes, man, they are always with us, Mark. It just seems like they're like always there. And you're right. Most of us think when we retire, wow, we're going to fall down a notch or two in terms of that tax bracket. But no, not everybody, right?
It's not the case. And, if you think about, let's just say a couple's, it has really good income and they have a certain lifestyle from that income, right? And so they're used to a certain level of income. And so if you think about that all kind of falls, what they try to do is they accumulate assets prior to retirement. And those assets eventually translate into income. You're buying income with those assets. But then, so you're replacing your income from work with income from investment assets and Social Security and pensions and real estate potentially as another income source from rental property. So they've got all these income streams. And so when you put it all down on paper, you're going, wow. Sometimes they realize, why am I working? I can make more money not working, right? And they realize that very quickly. And so it's really fascinating to watch them and go through that process and to go through that process with them. What I find is the high income earners, they have high exposure to the higher tax brackets because of their high income. They're not able to get the key deductions because their gross income is so high. And so they're really pushed into a very difficult decision of, gosh, I'm going to be in a high tax bracket for the foreseeable future. And I can't make some decisions because of it's going to affect a lot of things in retirement.
Yeah. But that being said, Mark, you know that there are things that people can do. And I know from working with you and talking with you, you're the kind of guy that says, look, let's zero in on one, the awareness, and two, some smart tax efficient strategies that we can take advantage of here to help minimize that tax that you're going to have to pay.
That's right. And so I looked, there are really two types of assets, right? Your pre-tax money, which is your 401k, your IRAs, your 403bs, money that you've been able to defer and not pay taxes on, right? And so you've got that bucket of money, and then you've got your other money that you've already paid taxes on that you've accumulated. Sometimes that's in the form of stock, mutual funds, exchange traded funds, right? And so the retirement money is a separate bucket. We'll focus on the non-retirement money first.
Okay.
There's a strategy that I often employ with, high income earners, and it's called direct indexing. And it's a strategy that's been around for quite some time. And what direct indexing is that, most people will invest in the index, like the S&P 500 or the Dow or the NASDAQ, what have you. When you own an index, you own a very diversified portfolio of that index, right? What direct indexing is instead of owning the index, it's a strategy where you own a a replication or a portion of that index. You actually own the individual stocks within that
Oh,
index,
okay.
right?
Okay.
So let's as an example, the S&P 500's five different companies. If you were to do a direct indexing strategy on the S&P 500, you would own probably 50% or two-thirds of those of the index, but you'd own all of those individual stocks. And
Hmm.
so it's quite fascinating because you're used to looking at your statement and seeing maybe a symbol called SPY, which is the S&P 500 index.
Yep.
But in a direct indexing strategy, you see 150 to 250 individual stocks. It's quite fascinating because you're like, wow, I own every one of these. The advantage of direct indexing is that since you have the individual ownership of the stock, you can do what's called tax loss harvesting. And if you look at a chart of the S&P 500 over the last 35 years, and hopefully we'll show that to our viewers, the S&P 500 in the last 35 years, you can see every year it's not a straight line up. In a year, in a typical year, the markets have gone up and down at some point. So with a direct indexing strategy, when the markets are volatile to the downside, what a lot of times the portfolio manager can do is sell those stocks for whatever reason the stocks went down,
Hmm.
take the capital loss, right? And I'll give you an example. Let's say they own Coca-Cola, right? You know,
Okay.
the beverage company, and for whatever reason, Coca-Cola's out of favor. And they go and they say, okay, we're going to sell Coca-Cola because it's at a loss. I'm going to take that capital loss because it'll help me in the future a number of different ways. And then I'm going to turn around and I'm going to buy something very similar to Coca-Cola, right? And so what I've done is I've swapped the Coca-Cola, I've taken the loss, and then I've bought something else that's very similar to that stock. And so I'm still in the market and tracking the index. What happens over a period of time? Now imagine that happening with 150 to 250 different stocks. So when the markets drop, they're going to execute this direct indexing strategy to really try to maximize the losses, right? And when they
Yeah.
maximize the losses because of that volatility, what you can imagine is at the end of the year, they've got a bucket of money of capital losses. And with those capital losses, that can help a couple of ways. If you've got a gain in a stock that you're going to take, those losses can offset those gains, right?
Mm.
So, you know, and or maybe it's not even a capital gain from a stock sale. Maybe it's a capital gain from a sale of a piece of property. So the capital losses in the direct indexing strategy really kind of help mitigate the taxes is what the end result is.
Yeah.
And there's a saying in the industry, it's not what you earn, but it's what you get to keep,
Yeah.
right?
No,
we
no, man. I heard that phrase a long time ago, and I have every bit of experience since I heard that phrase the first time
uh-huh.
is underlined the absolute truth of that simple statement. It's amazing.
Yes. You know, people when they come to me and we're doing these calculations, I always show them the after tax estimate, right? And it's like, oh wow, that's 13. You know, my income we were shooting for $10,000 a month, but then when we factor the taxes and we show them the tax bracket, I show them this is what you get to keep. So you know, it's really important to distinguish the difference, the gross returns versus the after tax returns. So you know, I find direct indexing for the non-retirement assets is a really good way to help strategically address some of the taxes. Other ways could be owning certain assets like you know, California municipal bonds. If you're in a different
Mm.
state, owning municipal bonds because they're exempt from federal taxes. So those tend to be the kind of the main strategies for high net worth clients is, you know, owning individual assets or owning a portfolio where they're doing direct indexing or owning municipal bonds.
Yeah. Now, let's stay with California because that's where you are.
Yes.
If I'm one of your clients and we're talking about strategies will those municipal bonds, if they're California bonds, be also state tax free as well as federal tax free?
Absolutely. So if you
Wow.
live in the state, and if we're in California and you buy a California municipal bond, it's exempt from both state and federal tax, right? So imagine you're the highest income earner, right, in the state of California, and you're paying, 40% in taxes, state and
Yeah.
federal, right? So if you make 5% on the bond, right, on a regular interest, you've got to pay 40% in taxes, right? You get to keep 3%. So
Yeah.
so that's the thing is, and if you earn 3.5 tax free, you get to keep all of it. So it does make sense to own California tax free bonds.
Mhm.
There is something to be aware of in the future if you're retired, because when you're retired, there's this thing called IRMAA, which is your Medicare premiums. And so they add up all of your income, including these tax-free bonds, and they hit you with an IRMAA tax, which is an increased premium on your Medicare.
Yep.
So, I mean, there's loopholes everywhere that you have to be really mindful of when you're looking at not only net income, but how does it affect Medicare premiums, right? So there's a lot of caveats to making income, and what
Yeah,
kind of
I'm
income.
glad you mentioned that, Mark, because I think a lot of people are not aware of IRMA until IRMA bites them.
That's
And then they're like,
right.
whoa, wait, Mark, what is this? What's going on here?
Right, right.
So, yeah, because for those who don't know, you do pay. Medicare is not free. You do pay, and you are going to pay based on your income, which is why working with a professional like Mark is so important, because he can prepare you for that reality.
Yeah, and it could be at the high end, it could be an additional 500 plus a month each, right? For each person in a household. So you're talking about $1,000 additional premium that you pay per month for IRMA if you go over that amount. So it's
Wow.
really fascinating, and it's something that you definitely have to, plan for.
Yeah, absolutely. So, what are some other ways that we can be tax efficient and be smart here?
A really big topic, and I spend a lot of time with this, is Roth conversions, strategic Roth
Mm,
conversions. And so, we talked about direct indexing with the non-retirement money, with the non-retirement money. Let's talk about how to address the retirement money you've got, right? So
yeah.
imagine you've accumulated 401ks, 403bs, what have you. The moment any dollar goes out of those type of accounts into your bank account, you're going to be taxed at regular income. And so there's another type of retirement account called a Roth IRA. Money
Hmm.
that gets put into the Roth IRA is never taxed ever again, right? So once the money
That's
gets there,
because you pay taxes on that money before you put it into the fund, right?
that's exactly right. And so some folks now in their 401ks at work have the option to do a regular 401k pre-tax, and they
Okay.
also have a Roth option. So that's a
Mm-hmm.
great way of, if you're still in that accumulation phase, maybe time to consider putting money in that bucket. But what a Roth conversion is taking money from those retirement accounts and moving it over to the Roth. And when I say strategically, you have to be careful. And I'm going to let's use an example here. Let's say you've got $1 million in an IRA account, right?
Okay.
Never paid taxes on that money. Everybody goes, wow, how do I get that $1 million into the Roth IRA? Well, you can do it simply one way. You can say, I want to move the $1 million over to the Roth, but guess what? If you do it all in one shot, you're going to pay income taxes on $1 million, right? So it gets
Don't
added
want to
to
do
your
that.
tax
Don't want to
Don't
do
want to do
that.
that, right? um, the other way strategically to do it is you do it over time, right? You do it over a window of 5 years, 10 years, 15 years, and you do it
Hmm.
methodically. And you do that with the mindset of, maybe you're at the 24% tax bracket, but the 24% tax bracket, has a limit before you go to the 32. So maybe you're $50,000 underneath the maximum income level for the 24% bracket.
Mm.
To me, I would look at that and say, hey, there's an opportunity up to 50,000 potentially to do a Roth conversion, right? Yes, you're going to pay 24% on that conversion, but you're
Yeah.
not going to pay 32, right? So strategically, you want to look at, do I have the room to do a Roth conversion? And of course, you want to coordinate that with the CPA, right? Because the CPA is more up to date with the taxes. They know what your projected income is going to be, but strategically you do that. And what I like to do with clients is develop a plan to say, okay, here's where you're at today. If we can convert this over a period of 10 years, by the time you reach this age, everything will be moved over to the Roth and you will have stayed underneath that 24% bracket.
Gotcha.
Clients that want to be more aggressive, they say, I just want to get it over with because I think tax rates are going up. That's a risk that we don't know either, right? And so some say, I would like to do it faster, and I'm okay to accelerate this over 5 years and go to the 32% bracket. So, again, there's many strategies. Don't forget, if you are Medicare age, we've got the IRMAA that we just talked about that we have to be mindful of. And don't forget, with all retirement accounts, once you reach 73, you're required to take a minimum distribution. So the government's going to force you to take out money from the retirement accounts once you hit that age of 73. So if you think about that, there's a window of time that's optimal to do these Roth conversions, right?
Yeah.
It's typically before you reach 73. Not that it couldn't be done afterwards, you can still do it, but 73, and then you have to be mindful of IRMAA, also Social Security, right? If you're Social Security, you're drawing that, it's going to increase your income. So you have to be mindful of all those things. Ideally, you start to address that before you draw Social Security and before RMDs. That tends to be the most optimal timing. And I'll say one more thing. When we work with clients, we do that analysis and look to see if conversions make sense. And what we found is for a lot of those clients is we show them that Roth conversions make sense. And over the lifetime, some clients are saving north of $1 million in taxes.
Wow.
And they've got a tax-free asset that they're passing to their beneficiaries. So
Yeah, I was just going to ask you about that, as a matter of fact, because you mentioned that when you hit 73, 74, there was an RMD requirement on retirement accounts, but those rules don't apply to Roth, do they? If I have a Roth account and I'm 73 or 74, I don't have to pull that money out because, well, I've already paid taxes on it, so it's free to go tax-free there, right?
Yeah, the government already got their taxes, Bill. So that's your money to do what you want, and think about the power. Doing it young enough, and let's say you converted that $1 million into a Roth IRA, and it grows over time to 2 million to 3 million, and nobody, and even your beneficiaries will never have to pay taxes on that, right? And it's just another asset that you have that you can pull from without any tax impact. So it's a great tool or a great account to have in the arsenal of, a diversified mix of assets that you can draw from. So
That's great. So I feel like I need to put a disclaimer in here for just 1 second, because if you're listening to this and you're not a client of Mark's, don't do this on your own. You need to be working with a certified financial planner. You need to be working with somebody like Mark, if it's not Mark himself, to help you walk through this stuff, because the rules here are really complicated. And, Mark, the government's kind of a stickler when it comes to these rules, aren't they?
They are, and it's always changing. The environment's always a little different, but yes, please, work with a professional. Certainly you can reach out to us, and we'd love to sit down with you and look at your specific situation, but see a professional, because these are pretty advanced topics. And, once you cross the line and you go over and you do too much of a conversion, those taxes are going to be due. The IRS is going to come for their portion.
Yeah. Mark Twain made jokes about it a long time ago, and it's still true today. Taxes are always with us, aren't they? They really are amazing. But the good news, and what I think people should walk away from this conversation with in this episode is, yes, taxes are a reality, but you can do things about them. You can take steps and you can mitigate those taxes and you can plan for them, right?
That's exactly right. And my clients that have done this for many years and are deep into retirement, they just accept that, hey, if I'm paying taxes, I'm making money. But there are ways to really try to optimize and mitigate some of the tax liability.
And so anybody who's listening to this podcast, if they are not a client of yours already and think you sound like somebody they might want to have a conversation, at least an initial conversation with, what is the best way for them to get a hold of you, Mark?
Yeah, I'd invite them to please send us an email, look us up online. Our information will be in the podcast. We're happy to do a Zoom meeting. You know, everybody's virtual these days, but we do a lot of Zoom meetings with clients and learn about them and address ways that we can help.
Excellent. The other thing, don't forget to hit the follow button, because if you hit this follow button, you're a subscriber. And the beauty of being a subscriber to the podcast is you don't have to remember when you heard this podcast, where you heard this podcast. You will be notified the next time Mark drops a new episode, and you can give that one a listen as well. I would quickly add, if you like the podcast, tell people about it, okay, please? Because word of mouth promotion is tremendous, and we would very, very much appreciate that as well. So until next time, I'm Bill Tucker. On behalf of everybody at 360 Advisors and Mark himself, thank you for taking the time to listen today. We'll catch you next time. Thank you for listening to Beyond the Dollar Signs Financial Clarity. Click the follow button to be notified when new episodes become available. Visit our website at advisors360pwm.com or give us a call at 408-778-8280. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Advisors 360. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions that you may have regarding your investment planning. ECA does not provide tax or legal advice. Guest opinions are their own. It may not reflect those of ECA. The viewer is encouraged to seek their own individualized tax and legal advice from a qualified professional.